Welcome to Hot Dispatches from the Frontlines of the Future. Today we're going to review the economic forecast from 2011 and 2012. Don't forget you can download it off my website so you can read the whole forecast. Despite the tragic occurrences in Japan over the past month or so with the tsunami and the earthquake and all the aftermath with the nuclear power plants and the extended and serious unrest in Libya and in the Middle East, the outlook still looks robust. We're likely to hit somewhere close to 3% in 2011. And by the time we get through 2012, we have a really good shot at getting to 4% growth. And that's really great news, and this is the US. But beware. By the time we get to 2013 and 2014, there's just lots of uncertainty. So the message is enjoy the short ride for the next couple of years. Let's just take a moment now and kind of take a look at the drivers and the brakes on the economy to really see what's pushing strong on both sides and why the forecast remains somewhat constrained still. So the big drivers are the Fed and the federal government, and so it's a lot of manipulation of monetary policy by extending the Bush tax cuts, by keeping interest rates low, by doing the stimulus packages still that we're doing on the economy. That artificially keeps the economy moving forward, and there's enough out there that will keep it going forward without much else through 2012. There's also great exports. We've been lucky that the emerging economies, China, India, Brazil, and others have been doing quite well since they took an initial dip of recession for the economy. And they're going to continue at good growth for the next couple of years, although certainly not at the same heights that they reached in the past couple of years. But let's take a look at sort of the brakes, because the brakes in some ways are very powerful in kind of keeping the economy in the US constrained. And of course, at the top of the list is high persistent unemployment. Now, we just had a drop to around 9%, a little bit below 9%. That's great news. We've been adding jobs. We've added over 1 million jobs over the past several months. We'll continue to add jobs. But it's still very high, and it's certainly not going to fall down to where it was before we went into this recession over the next year or two. There's also a lot of underemployment, well into the double digits, where people really are working much below their capacity and talent to work because the full-time, good high-end jobs just aren't out there. So that's a real concern as we move forward. Other brakes, of course, is the housing market. The housing market still hasn't recovered. We're still seeing prices fall this year. Most likely, unless something extraordinary happens, we will bottom out. But we still have a lot to take care of, so to speak. We still have 3 to 4 million foreclosures that we've got to manage through to completion in some way. And we've got a huge inventory of existing houses that we're going to have to work ourselves through in many parts of the country before we're going to be looking at a lot of new construction. So as long as the housing prices don't fall a whole lot more than 5% or so, a mean sort of nationally, they don't get down to something like 20%, this is probably not enough to derail the recovery of the economy. And then we have consumer spending. Now, consumer spending is a weak driver because consumers are spending. In fact, the savings rate got up to 6%, which was great, sort of from 0 to 6% right at the beginning year of the recession, but now it's falling again to 5% and probably lower. Now that's a feature and a bug. In the short term, it gives a weak boost to the economy to keep growing, but in the long term, we really need American consumers to constrain their spending, to save more, and get disposable income below where it is today, because it's starting to creep back up well into the mid-80s. And then, of course, we have commodity prices that are increasing. We've got food, we've got oil, These are hit the pocketbooks hard of consumers. They're not part of the core inflation measure, and core inflation remains very low. But again, as we look at these drivers and brakes on the economy, remember that be aware, because there's lots of uncertainties in 2013 and 2014, and in fact, it's highly probable that we could have a recession again in 2014, more likely a typical type of recession, not the kind that we just went through, but nevertheless an actual recession out there. So some of the big uncertainties that we need to look at are, the U.S. debt. We have not addressed that. We're not likely to address it and do a whole lot, despite all the machinations around the budget for 2012 we just went through. That's likely going to end up in higher interest rates. We're going to get some inflation. We don't think it'll be huge inflation, but nevertheless, economic conditions are definitely going to change. Sovereign debt in Europe, looks like Portugal's going to need some sort of a bailout now. And that's worrisome to really see how is all that going to sort out, since they're a big chunk of the developed world. And then just the volatility in the emerging markets. They're having inflation. They are slowing down. There's going to be a drive, many people that came out of poverty, there's going to be a drive pushing people back on the edges of poverty, which is very difficult for them, and also leads to social unrest, which can be a big break on the economy. So, and also, what's very important is the U.S. Needs to make some investments, despite the fact that we've got a big debt. Our infrastructure to support business and just ordinary life, physical infrastructure from roads and railways and ports, airports, needs to be invested in. So we have lots to do there. And in addition, probably the biggest imperative for long-term competitiveness in this expanding, very interesting, dynamic global economy, we have to invest in education. We have in K through 12, in our universities, otherwise we'll lose our preeminent position as the innovator and the most dynamic, high-end economy in the world over the next decade. So, the strategic imperative for each of you is, this is the year to be bold and be fast. This is a 2-year window of opportunity. You want to get ready to take your company to the next level and actually execute on that, because you need to be positioned. First of all, you want to get some profits back. That's very important in the short term. But you need to really be ready and have things in place so that you could ride out the white water of 2013 and 2014. So don't forget to download the forecast off my website, and we'll see you again at Hot Dispatches from the Front Lines of the Future with a great, deeper look at the emerging economies.